Thanks very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the ongoing series of the Greenwich Roundtable. Our topic this morning, Managed Futures Shock Absorbers for Your Portfolio, is a continuation at our look at this unique asset class or strategy group that last took place in February of 2003. Aside from short selling, which is more of a technique than a strategy, CTAs as a group are the only ones that made money last year. We've got two legends and one rising star. Oh, he's not rising star. He's already there. All best athletes. I'll introduce them after I say this. Our speakers' views are their own and don't necessarily represent the views of Roundtable members or the Board of Trustees. Peter Matthews, the founder of PJM Capital and one of the pioneers of the managed futures industry. He's best known for founding Mint in 1984, which employed a statistical approach to trading. In 1991, Mint was the first CTA to exceed $1 billion in assets, and Dr. Matthews was profiled in the popular book Market Wizards. Peter retired in 2000, but returned in 2004 to employ his complex adaptive systems approach for Caxton. He started PJM in 2008, and we're thrilled to have him here today. Sitting to Peter's left, Steve Evans is the director of Tudor's Systems Trading Group and portfolio manager for the Tensor portfolio and the Tudor Momentum portfolio. Both systematic trading styles manage about $3.5 billion. Steve joined Tudor in 1997 and is a member of that firm's management committee. Before Tudor, Mr. Evans was in charge of risk management software development at D.E. Shaw & Company. And before that, he was a senior manager in Anderson Consulting's Advanced Technology Group. In 1980, when he was 14, Steve started developing video games for the international retail market. Sitting to Steve's left, Ken Tropin is the founder of Graham Capital, a quantitative macro fund, and an old friend of the Roundtable. With more than $5 billion of assets under, and for the past 15 years, Graham is one of the leading managers in the business. Ken was also instrumental in the formation of the MFA and a steady champion of investor education, as witnessed by his leadership on our research council. Today, Mr. Tropin oversees Graham's quantitative research process and is chairman of the firm's management and investment committees. And finally, the moderator of the roundtable today is Ken Schuer. Ken and Mark Goodman run Kenmar, one of the few fund of funds that specialize in the world of managed futures. Going on its 25th year, Kenmar is one of the longest-running fund of funds in the industry. Ken's a trustee of the Roundtable, and he sits on our programming committees. Ken, like our speakers, has been doing this for a long time. Ken?
Okay, so we've all been properly dated. CTA, Commodity Trading Advisor, wins the award for the second worst name in the industry. Commodity Trading Advisor could not be further from the truth. Approximately, from my 25 years of experience in the business, 75% of what is traded in this business is financial futures globally. So that's my starting marker. The first and the worst name in the industry, proven by 2008, is hedge fund. Let me give a little clarification about what the CTA industry is, because I think there's a lot of confusion in the world. I think that the confusion around the industry is that this is a long-term trend-following community. And long-term trend following is certainly a component of the CTA world. It is certainly most likely the most volatile component of the CTA world, but it is only one of many parts. There are long-term trend followers, there are short-term systematic traders, there are fundamental discretionary traders, there are fundamental systematic traders, and there are high-frequency trading, just to name a few. The industry, when I started in 1983, was populated by only long-term trend followers. The industry has moved, probably mostly in the last 10 years, dramatically away from being solely a long-term trend following business, and have brought in other types of technologies, mathematics, and approaches that have differentiated it dramatically. A few performance statistics. The Barclay CTA Index has tracked CTA performance since 1980. Since 1980, CTAs have had an average rate of return of 12.2% compared to the S&P 500 10.4%. The last 10 years, both have had a 6.8% rate of return. Last year, Barclay CTA Index up 14% compared to the S&P 500, down about 37%. The last bit I'd like to tackle here is the concept of shock absorber. We wrote an article in 2003 for Absolute Return magazine and the question, the title of the article is, are managed futures a shock absorber for your portfolio? The answer, which has been proven over history, is most definitely yes. During dramatic drops in core portfolios, CTAs do perform. However, witness 2008, but also witness the last 20 years, 30 years, you can see that CTAs have actually provided a consistent rate of return to investors over a long period of time. They're not just shock absorbers. They have a place in every portfolio and actually have provided to us and to our investors a significant rate of return, in particular at times when we need it, but even in times when stock markets and bond markets have performed admirably, we've gotten good performance from our CTA portfolio. I guess with that said, I'll turn the floor over to our speakers. I have known some of these guys for a very long time. Peter, I knew when he started Mint with his partner many years ago, and I'm glad to see that he's back in the industry. He was and is one of the shining lights. So, Peter, would you regale us with some of your points here?
All right. Thanks very much. Thank you, everybody, for coming out this rainy morning. Well, as the speakers have said, we've been around quite a while, and that makes it difficult sometimes to get my points across in 15 minutes, because I'm a pioneer in the industry, and my back still hurts from all the arrows that I got back in the 80s. But I'm also a veteran of the industry, and I also was able to retire from the industry, and now I'm back. So there's a few things for me to say. Just very quickly, I'll go over the Mint history. It started really back in 1980 when I was a young statistician, and I was basically given the task to try and figure out what works and what doesn't in the futures markets. And I approached the issue with an open mind. I didn't go in thinking, oh, trend following is it. I wasn't imprinted with trend following as a mantra. I wanted to find out what works, what doesn't. And in 1980, that was actually a difficult job. It was hard to get data. It was hard to get time on mainframe computers. Everything was difficult. And to actually do a proper portfolio simulation across a whole series of futures markets was really, really difficult. But it gave us an edge. When I finished that research, I found out, lo and behold, that what worked was systematic trend following. And the numbers were clear. It just had worked for 20 years. It worked really well. The numbers were compelling, to me at least, and probably to nobody else at that point. So all I had was reams of simulations. But I said, this will work. This is a statistical process. If I follow this process going forward, I should end up with numbers similar to what I've seen in the past, at least on a statistical basis when you look at it from a portfolio point of view. So I'm going to run it just the way it was tested. So I started with about $2 million from a tax shelter partnership and traded for a few years with the new brokerage firm that had been set up in London by the Mann Group. And they watched this trading for a little bit, and after a while they came to the conclusion, you know what, we should sell Peter Matthews' system to our clients, because all these clients we're bringing into our brokerage operation, they're losing all their money. And it's just not a very good business plan. So they went up to the top people at Mann and they said, this is what we're going to do. We've got this system and it works and the people don't lose money and we still generate brokerage. What a great thing. And the top brass at Man, who at that time were basically sugar, coffee, cocoa traders around the world, they said never. We will never sell a public fund product in this company. And I believe possibly this is the beginning of that expression, never say never. Because the Man Group, as you probably all know, went on to become rather good at selling funds. And at one point had $75 billion under management in their fund of funds business. So clearly the brokers didn't take the advice of the top brass. They actually went out and tried to sell product. As a combination of, at this point now, being a partner with the Man Group in 1984, and they doing the marketing and we doing the trading, things worked out. We made about 30% a year before fees for the first 13 years that I ran the systems. So that tends to bring clients in. Man was very good at going around the world and finding clients. We developed the first guaranteed fund, and that was very, very instrumental in making this whole industry, I think, more acceptable to a much broader audience of institutional clients. So as a result of all this, we got to $1.1 billion in 1991. And we were by far the largest in the world at that time, probably at least double the next one and 4 times the next one after that. At that point, we made the fateful decision to stop marketing. And seemed like a good idea at the time. $1.1 billion, nobody had managed anything even remotely close to that in our space. We were on top of the world. We got people banging down our doors trying to do guaranteed funds. And we said, stop. We want to trade. We want to do research. We want to make sure we can handle liquidity. The Man Group had other ideas. They had really started to love marketing and sales, and they basically went off in that direction, created a fund of funds business, and later when we were looking for marketing assistance, they were kind of busy, so that was kind of the towards the end of the Mint business, and that's why in 2000 Man basically bought out the rest of the Mint partners, and so they could focus on their fund of funds business and leave us free to do whatever we wanted to do. So, as you know by now, I retired. And the reason I retired is that I felt I'd done everything I wanted to do in this business at that point. I had proved my professors wrong. They had said, this will never work. Are you kidding me? Systems? Can't happen. Can't work. No way. You want to do this for your PhD dissertation? No. We won't allow it. So I got that off my chest. 19 years of good performance, $1 billion under management, and all those things. I had helped the industry grow and mature. I had been involved in the Managed Funds Association predecessor organizations. I'd set up the Foundation for Managed Derivatives Research to sponsor academic studies on topics of interest in our industry. And I also felt like the industry had become somewhat generic. That whereas it had been extremely difficult for me to develop these systems in 1980, it was relatively easy in the 90s. Anybody could get their laptop out, pull up some data, do some testing, and they come up with a trading system. So it was becoming a highly competitive landscape, lots and lots of newcomers on the scene. And intellectually, I didn't think it was that interesting just to come back and say, okay, I've got my system, compete with all these people. Philosophically, empirically, we were similar. And so it then just becomes a marketing business. So intellectually, it wasn't that thrilling to me to get back into that business. So I retired. And like many people who have this kind of interest in systems and statistics and markets, and I couldn't stay away for very long. But if I was going to come back, I wanted to come back with something that was new, that was different, that was the next evolution, I thought, in what I wanted to do. And it was really focused around one key question, and a lot of the people here on this panel will understand this. So often over those 19 or 20 years, I would get the question, is trend following dead? I've even heard it this year. Is trend following dead? People would just say, hey, it worked, these guys did well, but it's not going to work. It can't work. It's not going to happen. It's going to stop. There's too many of you. Whatever the reasons were, the markets are more efficient, volatility's come down permanently, whatever the argument was, they'd say, what if trend following is dead? And I would give them my clever statistical answers about how it's always worked, and here are the numbers, and look at the fat tails, and all these things. But ultimately, that wasn't a completely satisfying answer. To really answer the question, I have to understand, why is it working? Why do we make these returns? Why did I find these systems back in 1980 that continue to work today? Why? And for that, I had to take a different approach, not the statistical approach to trading that I had always followed and most other CTAs followed. I had to take a more scientific approach. Say, let's get to the crux of what's going on here. What's the deal? And I, once again, with an open mind, started to think about it and say, let's get back to basics. What's an investment market? What makes it tick? And I realized, well, there's a few things that are pretty undeniably true about investment markets. Number one, it's a whole lot of people, like the people in this room, interacting to trade. And if you really look at the people and you talk to them and you get to know them, these millions and millions of people around the world who trade, they're all different. They're genetically different. They come from different geographical locations. They've got different age, education, experience. They've got different institutional constraints. They've got different mental or mathematical models of how they trade. They've got different response to news. They're just different. They're not the homogeneous traders with the same utility function and response to news that's assumed in finance theory. So they're heterogeneous agents. They're different. The other thing that's undeniable is that it's a feedback process. These prices that we see are the ones that we create as human beings. We see a stream of prices, we look at it, goes into our brain, it whirls around for a while. Whatever our unique features are in our mental models make us decide, buy, sell, do nothing. The collective response of all the people reacting to that stream of prices creates the next price, and so on and so on. Clearly, it's a feedback process. And as George Soros has pointed out, it's not only us interacting with those prices, we interact with the world around us and the whole economic system, and so there's a feedback process there. So we are affecting the economy at the same time as we're affecting the market. It's all a big feedback process. The other feature that's undeniable is that it's a self-organized setting. We spontaneously just decided we want to trade soybeans, we want to trade S&P, and we created exchanges and internet connections and all the things that enable us to do those things in the most efficient way possible. Nobody made us do it. And the last feature, and the one that really defines this process, is that it's a competition. We're all competing for a limited resource. We all want to make more money. We want to take our kids to the private schools and drive the Porsches and have the nice houses in the country. And it's a fight. And it's predator versus prey because it's a limited resource. Eventually, if it gets tough, we fight. And it becomes just like predator versus prey in nature. But what's interesting about these four things that I just said is that if you take those characteristics of heterogeneous agents interacting in a feedback mechanism in a self-organized setting, competing for a limited resource, and you go to scientists and you say, what is this? They'll say, oh, well, that's easy. That's a complex adaptive system. And depending on what field that is, whether it's brain function, immunology, traffic flow, ant colonies, whatever it is, they'll say, yes, and this is what complex adaptive systems do. They're highly sensitive to initial conditions. They're highly sensitive to shocks along the way. They're nonlinear. They will have bubbles and they'll have crashes. Equilibrium is not sustainable in a complex adaptive system, which is good news for us trend followers because it means trend following will never be dead because equilibrium cannot persist. So, and they'll say, these systems are unpredictable, completely unpredictable over any time horizon except possibly a few seconds, minutes, maybe a day. This is how complex adaptive systems operate. And to me, this was an epiphany. It's saying, okay, now I get it. We're trading in a complex adaptive system, and it's going to have bubbles and crashes and all these things that we've seen. That's what they do. That's what it is. It's not anything related to finance theory. Every assumption in traditional finance theory is wrong in the world of complex adaptive systems. All the people who won Nobel Prizes for terrific work in modern portfolio theory, etc., the mathematics is perfect, extremely elegant, wonderfully done. They deserve the prize for that. But it's based on the wrong assumptions. It's just wrong.
Some of them blew up.
And a few of them blew up. Some of the smartest ones blew up. So VAR, it doesn't make sense. Measuring means, variances, correlations doesn't make sense. They can shift at any time. They're totally unpredictable. You cannot predict the future. So here's this thing called complex adaptive systems, and it's got all these characteristics. And when I look at it, I say, well, now I understand why managed futures works. Because what does it do? It diversifies across as many markets as possible, because any of these paths that complex adaptive systems can have are incredibly dangerous, could be of any magnitude, could be multi-standard deviation moves. It's very dangerous. So you want to spread your risk as much as possible. We cut losses. It's a great thing, because these paths can be arbitrarily bad. And if you don't cut your losses could be arbitrarily big. We let our profits run. That's a good thing, because those profits could be arbitrarily large. These paths can be any magnitude. So we wait until the path actually turns before we get out. We want to get the reward from being on those paths. If we're going to take the risk, we want to get those surprise rewards. And we don't choose up versus down like everybody in the endowment world does. The endowment world says, I believe in up. I believe in the up path. I believe that there will be risk premiums. I believe the return on equities will be 8%. Whatever they believe in the up path. And we say, up path, down path, who knows? Complex adaptive systems can go in any direction at any time for any reason instantaneously. Correlations can go to 1. Contagion happens. All these things happen. So we in the managed futures industry happily go in either direction. Whichever way the path is going, that's where we want to be. Protecting our risks, riding the winners. So in that context, I actually look at this as the question, are managed futures a shock absorber for your portfolio? I think they're much more than that. Managed futures are a shock absorber. That's what they do. There are shocks all the time. Winston Churchill is the one who said history is a series of surprises. And that's what it is. And we're prepared for those shocks. The reason we did well last year is not just, there were trends. It's because we adapt to shocks. There were all kinds of shocks last year. We adapted to the direction. We adapted to the volatility. We were prepared for the shocks. For us, last year was like the most boring year ever. Our volatility was lower than normal. Our portfolio went smoothly. Our return to risk was better than normal. If you didn't know it was 2008 and you looked at the track record of our model, you'd say, well, it must be some other year. No, we adapted. We are a shock absorber. So, just to put it in perspective, and I've got to put on my statistical hat for at least a few minutes, otherwise I'd say, why did we bring Peter here? If you actually look at things the way we think is the right way to look at things, variance or volatility is the wrong measure of risk. The correct measure of risk, from our point of view, is something called the Ulcer Index. The reason that's a useful measure is because it looks at drawdowns. And in real life, it's the drawdowns that you care about. You don't care about volatility and standard deviation. You care about how much has my wealth just gone down? What percentage of my wealth did I just lose? That's a drawdown. That's how we react. As human beings, that's what we feel. That's the pit in our stomach. The Ulcer Index actually measures all of the drawdowns over the history of an asset or a strategy, summarizes it into a single number. It penalizes big drawdowns, it penalizes long drawdowns, and it penalizes combinations of those. And on that basis, if you look at Ulcer Index as a measure of risk, which we think is a much better measure of risk, and you look at managed futures on a mean to Ulcer Index basis, instead of mean variance, mean to Ulcer Index, we come out way ahead. We're way ahead of stock, 60-40 stock bonds. We're way ahead of the endowment model. We're way ahead of the hedge fund index. We're way ahead of other strategies. Measured in terms of real life, our feeling of drawdowns and how painful they are and how difficult they are to deal with, they are the key. I actually have a one-pager I put it at the back somewhere which summarizes those numbers for those who are interested in statistics at this early time in the morning. And when they told me about this roundtable, one of the things they said is that it's supposed to bring back the art of storytelling. And yesterday morning I'm in the shower and I'm panicking, so I'm thinking, I don't really have a story. So I tried to come up with one that I thought would maybe summarize what I've been saying in this talk in a non-statistical way, and maybe might get the message across. So I had this, in thinking of shock absorbers, I thought of a car, and I thought, well, let's say there's this car, and this car is supposed to be the mythical car that takes you to your financial future. And these two middle-aged women get into the car, and they're ready to go off on this journey to financial security. And they start up the car. The GPS comes on. They say, "Oh, great, we've got a GPS." And unfortunately, this GPS was created by scientists who understand about complex adaptive systems. So this GPS shows all the places this car has been, but it doesn't show anything about where it's going. And I think, man, this is useless. And then a little pop-up ad comes, and it says, "If you need assistance, please contact PJM Capital." And the woman in the other seat says, "Oh, you don't need PJM Capital. Don't worry, I'm a financial planner. I've got a map." And say, "Oh, great, we've got a map. It shows where we're supposed to go." So they head off in the car, and everything's great. They're driving along, having a good time, listening to the radio. And they come to an unexpected detour in the road. And they head left. And they're zooming along the road, and they go flying off the cliff at 100 miles an hour. And they're plummeting down to the rocks of financial ruin down below. And the one woman, who happens to be called Thelma, she says, "Help, what am I going to do?" And Louise is over here, and she looks down at her map, and she says, "Don't worry, Thelma, we'll get there in the end."
Peter, complex adaptive systems, as I hear you, listen to your description, almost sound to me like you're creating behavioral models. Is that a fair assumption?
In a way, I mean, it's a much more general behavioral model than the ones that have been studied in the theory of economics. It's basically saying it is people. People make the markets. It's us. We are it. We human beings. And our behavior is all different. So I don't have to actually characterize specifically what each individual's behavior is. I just know it's all different. As a result of all that different behavior, you never know what the other people are going to do. And they've actually proven this in some laboratory settings. They'll take a group of people and throw them into a room, and they'll say, "Trade this asset." And they'll even give them the future cash flows of that asset and say, "Start trading." And they start trading, and everything's civilized for a while, and then it starts to go wild. And you start to get bubbles and crashes and all these things with an asset that everybody should know what it's worth, because they're dealing with the other people, and they don't know what the other guy's going to do. "Oh, he keeps buying. That annoying person keeps buying. What am I going to? Maybe I should buy. I don't know. Oh, I'm losing a lot of money. I better get out of this." All the things that we do start to happen in this laboratory setting. So it's absolutely about behavior. The problem is we never know what these humans are going to do. That's why it's unpredictable. It's exactly why it's unpredictable, because it's humans. It's not about supply and demand. It's not about economic theory. It's not about the normal distribution. It's not about mean reversion. It's about what are these people going to do next? And we never know. And that's why it's so dangerous.
We had to bring one young pup along. So we decided to invite Steve. The poor guy's only managing $3.5 billion. Steve, you want to give us some of your thoughts?
Yes, thank you very much. I thank the Greenwich Roundtable for the invitation. It's a privilege to be here. As alluded to, I do feel like the relative young upstart amongst these two distinguished veterans in the industry. That's a tough story to follow. I changed the story where the machine came up with contact Tudor investment, by the way. That was a nice plug there.
It's going to be an infomercial.
Yeah, exactly. Just saying no infomercials. I'll try to keep mine.
A little competition at the table. I like that.
That's fine. So, and I have to say, when I was building video games, trying to do the trajectory of a Space Invaders missile, trying to hit the player's base, I should have been plotting trend algorithms in financial markets, because it would have been a lot more profitable, especially in the 80s and 90s, where we find simulations do incredibly well in those periods of using the latest and greatest techniques. It is harder now for a number of reasons, probably. I think the complex adaptive system analogy is a good one. And I think that, we look at trend following and think about the cost of information and the speed of information to all the participants. And I think as that speeds up, or there are more players, it gets more difficult, but it's still one of the most viable strategies out there. When I looked at the suggestion sheet for the speakers, it said the audience appreciates the speakers' insights on risk. And what I thought I would do is, not talk about the shock absorber effect, because that's going to be well covered, I think, and many of you probably seen the charts where you add CTA or managed futures strategies or indices to existing portfolios, and return goes up, volatility goes down, and it all looks like an improvement. I thought I'd talk about the risks in the shock absorbers themselves, in the sense that strategy as a space still needs diversification. We feel that it's not. You can find a lot of trend followers, and there are definitely very good ones. There are definitely ones where the returns don't have the same attractive nature as the best in the space. And clearly, risk management is essential in any financial strategy. But the way to improve risk reward is through real diversification. And what I wanted to try and do was give you a feel for the different flavors and the decisions that can be made. Maybe even provide a mini framework where, if you were going to talk to managed futures managers, you could ask questions in these areas. It might help you distinguish one from another. So I hope that's helpful. Now, there's a myriad of decisions to be made when these systems are built and traded. But the four main areas we find that distinguish one system from another are the universe that you trade, the time frame or the speed of the system, the data sources that you use, and then the type of signal you're going for. I mean, there are a whole host of decisions to be made in signal processing, risk models, transaction cost models, portfolio construction, and execution, which are another set of areas. But at the end of the day, the best risk model, the fastest portfolio optimizer, the lowest slippage execution model will not make profits from poor alpha and poor signals. So we're going to talk about those four areas, hopefully within the allotted time frame. So the universe of assets traded, as mentioned, I mean, managed futures is a very rich space. You trade typically the world's most liquid futures and FX markets, often including emerging markets these days. Multiple instruments obviously creates a great deal of diversification. But as we've seen, there are times when the correlation across these instruments causes the apparent diversification to drop significantly. You may all be familiar with July last year, where nearly every hedge fund strategy was in the red. There are times when there are other thematic bets, such as the risk-seeking behavior or risk-aversion behavior of the whole industry, or enough players in the industry actually create a larger risk factor than the individual assets themselves. And that's something to be considered. But and for example, if you look at the average pairwise correlation, even of equity markets since the 80s, you will see it slowly climbing. In fact, all the discussions on whether the world's economies are coupled or decoupled kind of got blown out of the water last year, when it's pretty clear that everything's pretty linked now globally. Sort of debunking those theories. But at the end of the day, starting with as many assets as possible and understanding their relationships is a great start to diversifying. And managed futures does that much more so than many other asset classes. I mean, the many other strategy classes. The embedded beta is certainly reduced, and it's often negative if markets are going down. The next one is frequency. And by frequency, we mean the speed of the system. You can hold something for a few days. You can hold something for a few seconds in market-making strategies, and you can hold something for over 6 months. Interestingly, if you're looking for diversification, and you will have seen this if you analyze different managers, the short-term holding period tends to provide by far the most diversification. And there's not surprisingly, if two people hold assets for 3 to 6 months, even if they built them using very different techniques, they will overlap in exposures and risk terms. They may get in and out at different times, which can be the difference between very good profits and mediocre profits in trend following, but they will certainly overlap in terms of risk exposure. If you only hold an asset for 5 to 10 days, or even 2 days, there are much more combinations and permutations of trades which don't overlap with each other, and there's much less likely to have overlapping drawdowns. Because where I agree somewhat with Peter that the Ulcer Index is another good measure. I mean, information ratio is still important, because information ratio, when you capture serial correlation, can tell you a lot about the potential for drawdowns you haven't even had yet. But drawdowns are the things that hurt the most. And putting models together or portfolio together, you want to watch where drawdowns overlap. If two managers overlap on their drawdowns, yet they have less correlation than another manager, it's possibly more important to consider the drawdown overlap than it is the correlation. But at the end of the day, so frequency is very important. Now, the problem with that is it's not a free lunch. Short-term models, hopefully the panel agrees, generally harder to find, and their lifespan is often shorter. The alpha decays more quickly, and their effect may go because the microstructure at that level in the marketplace is more dynamic than the longer-term aspects or features of trend following and say, fundamental trading. The next area is data source. we typically break data into two types: technical data, and by technical data we mean price, volume, information about the asset itself and its derivatives. There's also fundamental data. Fundamental data being economic release data, analyst forecasts, or even market discoverable fundamentals such as interest rates or the yield curve backed out of fixed income markets. Using different data can lead to different signals. There are times when markets are very momentum or sentiment driven, and trend following is probably one of the most efficient ways in those places because the fundamentals are not being paid attention to. That's certainly true right now. It was certainly true in 2008 and even in 2007 to some degree. Fundamentals are not really being considered by large players in the marketplace. However, there are other times where trends or price movements are hard to discern over the noise in the market, but the drift towards equilibrium is being driven by, or temporary equilibrium, is being driven by fundamentals. And there are times when the fundamental systems will work out well. Finally, and this is a huge area, but signal type. There are obviously many ways to construct a signal, but we're just going to break it down into two areas: directional and relative value. Directional models usually forecast single markets and their direction. Relative value models are trying to signal or forecast multiple markets together. For example, a relative value forecast might be, I think the US stock market will outperform the EU market by 2% over the next month. That's a relative value bet, and the nice thing about relative value bets is you don't care if the global economy bumps all stock markets down by 10%, as long as the ones you're long versus the ones you're short outperform, you get a different bet. That's quite important with the trend following portfolio. If you've already got trend, because in trend, you'll have seen this, you will likely go long most of the equity markets together. However, if you're going to do relative value bets, you might go long Europe versus the US in some periods, and you might go long US versus Europe. So there's a natural offset for some parts of the portfolio when you put those things together, which reduces risk, hopefully improves information ratio, and should also improve other measures of performance. So given all those, I hope that you can see that there's a huge set of combinations for building these models. And I'll just cover a few examples. I mean, we've already spoken about trend following. If we put it into these different areas, usually 3 to 6 months holding periods is the meat of trend following. It's a technical, usually price only, it's directional, and it usually trades all the asset classes. If we then look at global relative value, or also known as GTAA, you may have heard the term GTAA or TAA, Global Tactical Asset Allocation. These models are usually fundamental, long-term, and relative value in nature. They usually trade currencies, equities, and fixed income. Rarely do they trade commodities. It's hard to do relative value in commodities. You can do it within a class, but the products are not generally substitutes for each other. It's hard to say, I'm going to go long wheat and short oil, and say if you found some fundamentals that drive that relationship. So generally these models will be cross-country selection models in currencies, fixed income, and equities. They may also be stock cash timing models, as in a model that predicts when you should be in stocks, when you should be short stocks, and when you should be in cash, and same for fixed income. These models may use a huge variety of fundamental signals, including measures and transformations of GDP, current account, proxies for industrial production, car sales, interest rates, analyst forecasts, purchasing power parity measures. A huge variety of data can be used here to provide diversification for the signal. Another area, let's talk about some short-term models, because both those strategies, trend following, global relative value, tend to be of the longer-term nature, particularly fundamentals, where the data is usually quarterly or monthly and often subject to revision. It's a whole other modeling challenge to handle data like that. In the short-term space, it's hard to sort of break them down and to say consistent buckets to classify them. But pattern recognition is a term you may often hear. We like that term just because it's not really implying trend or counter-trend behavior. It's usually technical, short-term. It often trades all the asset classes and is usually identifying a pattern in a given time series, which we believe leads to a subsequent move that we can take advantage of. You could be seeing a certain set of behavior that we believe sets the participants in the marketplace, is more behavioral finance in nature, into a position where should the market move in a direction they feel they have to get on board or they feel they have to get out of their positions. And there are many short-term systems, and some of them trade all asset classes, some of them are specific to one market versus another. Equity markets have more mean reversion behavior than other markets generally, and you can find things that are specific to an asset class in this space. And then finally, we also have counter-trend models. I mean, you'd think that the counter-trend models might be the ultimate shock absorber for trend flying, to take the shock absorbing down from the level. They are very, very hard to find. Probably one of the reasons maybe trend following works so well. Counter trend is where you would try and predict a range-bound market and sell against a move to the outside of that range and buy a move on the downside towards the outside of that range. It's very expensive if you get it wrong, because the market runs. You have to pick a point to get out. It is possible to build those models, and they are very powerful. They usually have limited capacity again, because they're usually short-term in nature, because you're not riding a trend for a long time in those particular models. Anyway, finally, so I hope that gives you a feel for the richness of the space and the fact that you can further seek diversification. It's not just trend following. It's not just the usual definition of CTA or managed futures. It has its own sub-allocation to try and build a diversified portfolio. Thank you for listening.
Thanks, Steve. Quick question for you. Back in the days when you were probably designing video games, I had dinner with a guy named Richard Dennis, who's an old-time systems designer.
The Turtles.
Of one of his claims to fame, for sure. He told me, thank you. He told me that he felt that the average system has approximately a 2-year shelf life. How would you comment on that?
I think it's a large overgeneralization. Some systems we have systems that have been running live for nearly 10 years and with basically no changes. And there are some systems that do decay within 6 months. And it's a function, we find, of time frame and the effect that you're trying to extract. But having said that, it is certainly true that constant research and innovation is definitely a differentiator. I mean, we have 60 people in the systems. We've just dedicated to systems trading at Tudor. The firm is 400 people, so that's a huge chunk of resources. And as Peter said, for us, it's for quants and people in my group, we feel this is one of the greatest competitions you can take part in. And constant innovation and searching for new ideas to increase the diversification and make sure you stay ahead is essential. So yes, some systems do have that lifespan, but other ones can last a long time, and some of them can only last a few months.
Thanks. Ken, you want to take a shot at this?
Sure. I thought, first of all, let me thank Ken and Steve for inviting me to speak at the roundtable. It's been some number of years, I think. I thought I would talk about two subjects today, knowing in advance that Steve and Peter would do a very good job of giving people a nice overview of what the kind of trading strategies all of us use in one form or another try and do. I thought I would spend part of my few minutes here talking about how our firm has changed in terms of our trading approaches and our strategies, how they've evolved over the years, and this is frankly a reflection of the industry and how it's evolved over the years. Steve touched on some of these points, frankly. And then I also thought I would spend a minute talking about an academic study that two of our very bright quants have put forth and is being handed out to you, and do not want to get into a heavy statistical conversation here or dialogue, but I did think it would be useful for all of you to consider some of the conclusion and some of the analysis that was done in the study, so I'll spend a minute on it. First of all, a second on Graham. Graham's been in business 15 years. We're a little interested in the macro space in that we are involved in macro both from a discretionary point of view and a systematic point of view. We have about just under half of our assets in the hands of discretionary traders, and we have a little more than half of our assets managed by some type of computer model. So we're in both styles of investing, and we do that for a very easy to understand reason. It's the best way to get diversification for our firm, our clients, our proprietary capital. With 160 people in row 8 in Connecticut, the background on the firm. We've been in business since 1994, and when I started the firm in 1994, we had only one time horizon. You heard Steve talk about how it's important to diversify through different time horizons. When I started the firm in 94, we had only one time horizon. It was very long term. We used two trading systems that were slightly different than each other. If we fast forward 15 years, today we have nearly 40 separate trading programs that we roll up into one fund or strategy that people invest in, and they now include high-frequency trading systems, which we define as models that hold a position for less than a day. And those models have 3 time horizons, 10 minutes, 2 hours, and 6 hours. Then we have our short-term models, which are those systems that hold trades for 1 to 10 days. And as Steve mentioned, there's not too much overlap between one short-term strategy and another, which is a useful thing from a diversification point of view. We have our intermediate models, which hold trades for 10 to 30 days. And then we continue to have our long-term trading models, which hold trades for more than 30 days, and they tend to be in that 2-month, 3-month category. To Ken's question, we still use the original trading systems that I came up with in late 1993. So they're pretty robust. We have made some improvements to them over the years, but one of the things we haven't changed is how they time the market. That's exactly the same as it was 15 years ago. And those 2 systems that I designed 15 years ago have only had 1 down year. So they continue to hold up respectably well. All of our systems in the early days used what we called alligator, or open high-low close data. Essentially, you're looking at 1 piece of data per day per market, and it had the open, the high, the low, the close. You didn't have any transparency into how did you get there. Was the did you open at one level and then was the low? Did that happen towards the end of the day, the beginning of the day? Today we spend an awful lot of time on data management and using systems that run on tick data, which give us a lot more information in terms of short-term trading. 5 years ago, so not so long ago, Graham in our trading business averaged about 500 trades a month. It might seem like a fair amount, but today we average somewhere between 50 and 80,000 trades a month. So it's an enormously different business in terms of the amount of technology infrastructure that we need to have to support that business, and obviously the speed of the models, that kind of thing. We have an enormous investment in electronic trading. Obviously, you couldn't have people making that frequency of that volume of trades. We have an enormous initiative in smart execution. Just to spend a second on smart execution, this is something that didn't exist in our industry maybe 5 or 7 years ago. This is an entire department in our research group that spends all of its time trying to enhance the actual execution of each order. And what are they really doing? If you think about what you do when you buy a stock or you buy a future or anything, there's a bid offer price. And the offer price is where anyone in the market is willing to sell you that, at least for a certain quantity, and that's what you know you can pay for it. The bid is what you can sell something for. What smart execution tries to do is better than that. We're trying to buy at a price less than the offer price and sell at a price higher than the bid price. And how we do that is the art and science of smart execution, trying to understand things like the depth of the market, the replenishment rate of the market, all kinds of technical things. But essentially what we're trying to do is at least buy at the mid or something better than the mid and not pay the offer or sell at the bid. A few years ago, almost all of our orders were handled orally, one trader on a trading desk to a pit. Today, 98% of our orders are machine to machine. We still do some volume of our orders the old-fashioned way, particularly in commodity markets where the depth of the electronic markets isn't very good. But it's gotten to be obviously a very technology-sensitive business. Our research department 5 years ago was a little less than 10 people, and for a firm our size, it was pretty small, and there was a reason for that. I made the decision in those days that if I had a large research department, I was going to have a lot of intellectual property leakage, and I was very concerned about that. And paranoia about people walking away with our systems was a risk factor that I thought was too great to overcome, so I kept the department small. Eventually, I realized that we were becoming a dinosaur. And that is the nature of our industry. If you stand still, if you don't use creativity and innovation, the world passes you by. And so we had to find ways of managing our IP risk and our security concerns, and we found some techniques to do that, which I'm sure Steve does and others do. And we have grown that department to where we have 75 people in research and technology who support our efforts. Obviously, there's no way to do the volume of trading that we do, including all the time horizons that we're using with a small research staff. So I often use this expression. It's become a little bit of a nuclear arms race in our industry when you're trying to compete with the Renaissances of the world, the Shaws of the world, and so on, in terms of having not only some of the brightest people, but also, very importantly, some of the best data management and some of the best technology for electronic trading and also smart execution. So those are some of the ways that the industry has changed. A couple quick comments. If you think about why would you have this asset class in your portfolio, we have been doing this since 1994. Interestingly, Tudor was my original partner in this business, and still a very, very close friend of our organization. But in that 15 years that we've been doing this, we have had a negative correlation to the S&P of minus 0.25. And that's a pretty stable statistic. That does not mean that we are a hedge. And people often talk about, well, I have this allocation to systematic. We don't call it CTAs. We hate the term too, Ken. We call it systematic global macro. But it's probably another lousy term. But anyway, we have had this lack of correlation to equities, and yet, importantly, we go long stock indices when they go up. So I never like to think of ourselves as a hedge. But I do think because of the markets that we trade that are different from equities, there is no beta component to what we do. And therefore, we tend to be a reasonably good diversifier for our clients. And the fact that we have a very different time horizon and go short as well as long and all these other things that people have mentioned is some of the useful points that I would make in terms of how do you look at this thing. But never look at investing with a systematic macro trader as a hedge. You need to look at it as a diversifier because, there's going to be a period of time where we are long when equities go down, and hardly a hedge. Short selling is a hedge. We're not. The other thing I wanted to talk about is we did a study called Systematic Global Macro Performance Risk and Correlation Characteristics, and I thought I'd spend just a second talking about some of the key points that it makes. One of the main points that the study makes is that traditional measures of risk are flawed, in our opinion, for some key reasons. And I don't want to get enormously technical here, but let me mention one of the big issues. One of the most common measures of risk that people use in our industry is a Sharpe Ratio or an information ratio, essentially looking at annual return divided by annual volatility. And one of the problems with that risk measure is it assumes that there is a normal distribution of monthly returns, meaning that there is no serial correlation between monthly returns. And so it therefore underestimates the problems associated with left tail risk. And when you look at the serial correlation of returns, you find in most hedge fund categories there is relatively high prevalence of serial correlation between returns, meaning the problem with that is if I have a bad month in one style of hedge fund investing, it might be followed by another bad month and another bad month known as the left tail. And if you don't account for that in how you do a Sharpe ratio, then you are underestimating risk. So I'm going to call you to a few key pages in this and then turn it back to Ken. I think it's worth just spending a minute on this. If you focus on page 11, I know, Steve, I'm breaking the rules here by going into this, but I think it's...
Anything for you.
I promise to make it short and quick. If you look at this table on page 11, this is the standard way that people look at returns, which is what's the annual return of a style of trading, and what is the annualized volatility of that return, and what is the Sharpe ratio. If you then look at page 12, we're getting now more granular in what those returns look like, and we're looking at upside volatility, downside volatility, the ratio of upside volatility to downside volatility, skew, which says are you likely to have a right tail as opposed to a left tail, and kurtosis, which means what is the probability of a fat tail. Then if you look at, let's move on a couple quick pages. If you look at page 16, if you look at the comparison of annualized vol versus annualized vol adjusted for the presence of non-normal returns, you're going to find that in every case except for short selling and systematic global macro, the typical risk measures used by the industry overestimate the risk-adjusted return of most hedge fund styles and underestimates the return of systematic global macro. Why is that? Because systematic global macro is the only category in the hedge fund universe, along with dedicated short selling, that has a reasonably normal distributions of return. And when you adjust the Sharpe ratio for those styles of hedge fund investing that have the presence of serial correlation in returns, meaning the returns are not normally distributed, the risk of those strategies goes up measurably, and the Sharpe ratio goes down measurably. And so that information is contained on page 16. Another ratio that's useful looking at is found on page 17, which is looking at, I think Peter talked about this, he called it the Ulcer Index. It is the magnitude of a drawdown compared to the annual volatility of the strategy. And again, systematic macro actually comes out relatively well in this regard. Finally, if you go to page 19 and then page 21, you're going to see some interesting things about correlations. In correlations with the stock market on the bottom of 19, to my point earlier, over 15 years, systematic global macro is the only thing that's had a negative correlation to the equity markets, which is an embedded beta in most hedge fund styles. How much so is always a subject of debate, but it tends to be present, at least on a statistical basis. And, finally, going to page 21, looks at the worst drawdowns of the S&P compared to systematic macro. And then kind of portfolio construction issues on 22 and 23. If you readjust the Sharpe ratio of different hedge fund styles to take into account the non-normal characteristic of the returns, you get very different weights between the box on page 22, which doesn't do that, and the box on 23, which does take into consideration the relatively normal distribution returns for systematic macro and then non-normal distribution returns for non-systematic macro or other hedge fund styles. So I leave this with you. It's obviously pretty good if you can't sleep at night to spend some time on this. But let me conclude my remarks by saying that if you think about our industry, and I've been involved, known Ken since he started this business in '84. Spent an early part of my career picking managers, including Peter, in the early days of his career in the '80s. This is the one style of hedge fund investing that over, 2.5, almost 3 decades now, has held up pretty well. It's episodic in its performance profile. There's certainly some lumpiness to the returns. Some of us managers, Steve has done a great job of this. We try and do a good job of this. We diversify amongst time horizons much more than we used to. We do short-term trading. We didn't used to do that. We take advantage of technology that didn't exist 5 years ago. We take advantage of cheap transaction costs that didn't exist 10 years ago. We do an awful lot of things to take away from some of the episodic nature of the business. But at the end of the day, even absent those things, this is the one category in the hedge fund universe that's been negatively correlated from the main asset class that people are trying to get diversification from, that has performed pretty reliably on the upside without too many changes over a very, very long test of time in both bull and bear markets for equities. And therein lies, I think, the supporting argument for it. There are a lot of statistical measures that we look at that I think are worth noting here, but the reality in very simple terms is if the idea of investing in hedge funds is to make money and have growth in your portfolio that is not correlated to your traditional investment strategy, it's a style that's held up well in that regard. So, Ken, back to you. Thanks.
After listening to your talk, Ken, I want to come back into my next life as your broker. In the interest of time, since we've run a little bit over, let me turn it over to the floor here and see if there's some questions. I'm counting on you, Steve. You're first on my list, always. You know that. Go for it.
I'm only going to ask one question at a time.
I don't believe it. It'll be one question with 3 parts.
I'm going to ask 2, but actually, Mr. Tropin, you're much better looking in person than this article, and you've actually done a very good job explaining your firm quite candidly. So I'm going to go to a quick update on yours. There was another study that was done by NBER. The title was called Fooling Some of the People All the Time, the Inefficient Performance and Persistence of Commodity Trading Advisors, released in October 8. I'll just read 2 lines to get to the point. Using data between 94 and 07, Weber Tasker showed that survivorship and backfill bias overstate the reported returns for CTAs by more than 800 basis points per annum. Last correct annualized returns average 5%, a mere 85 basis points over T-bills. We estimate gross CTA returns significantly exceed that, therefore outperform charging fees go to the pocket of the CTAs. Damning comment here. We find the average CTA exhibits no skill alpha relative to these benchmarks, and we conclude that poor CTA performance has persisted for at least 20 years. CTAs are a kind of market failure. Pretty damning.
Can I comment on this one? We actually have done it.
I want all 3 of you.
Yeah.
Actually, it'll be all 4 of us.
We got that. Someone sent us that study, and I would say that is the Yugo of academic studies. And we have a very comprehensive rebuttal that my staff has prepared for that we would be happy to send to you. But it is absolutely flawed from top to bottom, and the work quality of that is seriously statistically and academically inaccurate.
But they seem to focus on the average CTA as opposed to the top performance.
Well, I was going to say, one of my rebuttals is, look, you can take, I mean, they're singling this industry out there. You can do that with any strategy class. I mean, it's well known that the average active mutual fund manager doesn't outperform the S&P 500 index, yet people still invest in. So, yeah, and I'm sure that I share Ken's views. I mean, it's a poor study.
Yeah, again, I believe that the numbers speak for themselves. I've done simulations for the last 30 years. Everything I've tested on the kinds of strategies that certainly the people at this table run, they just work. They absolutely work. I don't know what happens when you bunch together a whole bunch of CTAs and you make an index and you do some weighting and all these things. I know what we do works. I know exactly why it works. I know why it will always work. That's what's important to me.
Yeah, I would. We left a short study that we did on the table outside, which, by the way, addresses a lot of those points. I would say that a lot of the data set that they looked at was flawed. The information is wrong. I mean, I've lived through the performance of CTAs for 25 years. I think that they've looked at a very flawed set of information to come up with those conclusions. Go ahead. Yes.
Have there been any high-profile blow-ups or failures of CTA strategies, and what might have gone wrong with them in the last 10 or 15 years?
There have been. Well, let me comment on one thing in that CTAs tend to have some managed accounts, some more than others. When you have managed accounts, you take a lot of the operational issues off the table, but you also have an issue called parallelism, which is you've got to trade similarly across different accounts. And by having other people actually watching, most CTAs have a main fund, and then they have managed accounts that they trade in parallel, pari passu with their main account. When you have other people watching, that becomes a tremendous policing mechanism for the business. So I'm not familiar of any fraudulent activity in the but
the only CTA that I can recall that's ever sort of technically blown up was really not a CTA. It was a discretionary macro trader. It was, Niederhofer, and that's the only one in my, been in that industry for 28 years. I've never. One of the things that the industry has always had is a number where if the CTA dropped X amount, his clients fired him. That was used to be in the old days. That was in your disclosure document, and it was a pretty sensitive point where if a manager, when I ran that business for Dean Witter in the 80s, if a manager dropped X percent, he knew he was getting canned, and that did happen for sure. And that number tended to be 25, 35, 40% drop peak to valley. You were canning the guy, and that clearly happened. But in terms of a guy going belly up or just going to zero and having a deficit with a broker and all of that, no.
Yeah, Niederhofer would be the only name that I can remember as well.
I mean, the industry evolved quite a bit from the time when I started. In the early 80s, there were probably more of the so-called gunslingers who would trade very aggressively. They just thought trend following was fantastic, and they would gear up. They would have annualized volatility of 50%. Not surprisingly, their performance when the drawdowns came was significantly worse than the average CTA. As the industry matured and evolved, and the more experienced people continued their businesses, you can see, in listening to the people here today, it's all about risk management. And the real veterans are the ones who traded for a while, who understand the nature of this business. It's all about risk management. It's all about controlling that left tail. It's all about not being the one who blows up. And from my point of view, what I think about every day is, how do I make sure I'm not the prey? It's predator versus prey, but how do I construct my portfolio so they can't get me?
Yeah, and furthermore, it's liquid, transparent, daily mark-to-market, exchange-traded, generally instruments. I mean, you've got, you won't see any CTAs or systematic global macro with side pockets, with suspension of redemptions. I mean, it's usually got some of the most attractive liquidity terms. So I think that there's never been any sort of other sort of behavior like that either, which I think is also an important point.
Yeah. And I really want to emphasize the self-policing mechanism of managed accounts and parallelism, because it's a wonderful it's a wonderful control factor in which everybody has managed accounts, which does keep an oversight over the industry. Jeff?
Sure. This is for each of you to address how you respond to this, what used to be somewhat of a common statement, and how your firms have addressed it. Technology might have also addressed the following: is that it used to be said that sort of CTA strategy could be somewhat mean reverted, and that if you look at the annualized return over a certain period of 10, 15 years, that there was some investors would try to sort of, in essence, time the investment into the systematic strategy, whether it's, after a great year of 20+%, would usually mean, time to step aside, and you really want to get into systematic trading when they're in the hole, so to speak.
Jeff, I can go first, I hope. So, I think that's one of my favorite and common questions we get from investors. Should I invest after a drawdown, or you've just had a good run? Is it mean reverting? And the first and simplest answer is if we could find that behavior was predictable, we would change the system immediately. I mean that's such a simple change. It's such an easy test empirically. There's also actually a very good paper written by I think the quant who works for New Edge on their website, which is titled something like "Is there a rainstorm after every drought?" which is exactly analyzing that point. They take a huge set of CTAs. They look for predictable autocorrelation in those time series, and in statistical speak, they reject the null hypothesis every single time. So I think it's a great question, but there is none. I wish we could find it ourselves. It would make our strategies even more attractive. So.
I think Ken, with what he was talking about earlier, is really answering that question, because it's saying we're normally distributed. Because we have a normal distribution, because we don't have the big left tail, because we control risk, we can't be timed. And God knows I've tried, just like Steve talks about, and I've had a long time to try it. And you cannot time CTAs. You never know when that next shock's going to come that we're going to help you absorb. You never know when it's going to happen. It could happen at any moment, at any instant. That's the nature of complex adaptive systems. So trying to time is really bad thing to do because you might miss the one thing that you needed it for to catch the next big move. And it might not be a down move, it might be a big up move. You don't want to miss it. If you've waited and you happen to wait and there is a drawdown, then it can be a good time to get in just because you happen to have waited. But you should not wait. That's wrong. Conversely, just to follow that up, I've looked at a lot of other hedge fund strategies, and because they've got these left tails, because in fact they have the serial correlation, timing other strategies actually can pay off. Getting out when they're doing badly can be a good thing. Getting back in when they start to do well again can be a good thing. You can almost time these other strategies the way we time trading of gold and silver and the S&P, because they have that nature of having occasional really bad outcomes. It's why I didn't believe in replicating hedge fund strategies, because I didn't want to go off the cliff with the hedge funds when they got it wrong. So replicating seemed like a really bad thing to do. But finding a way to time the other hedge fund strategies by using replication techniques to use the assets that they're using under the surface to get out when they're doing badly, that can work.
I do have one slightly different view on the subject, and it's more pragmatic than statistical, which is to say that I think investors who are allocating to this style would be best served by deciding what percentage of their portfolio they want in the style, and most likely not to invest that all at 1 month in their life and say, okay, I'm picking this month to put all this. Let's say the number is 15% or 10% of their hedge fund portfolio, and say in 1 month I'm going to go from 0 to 10%. I would much rather see that investor, sort of every other month for a period of 5 or 6 months, put their capital to work. I think that will serve the investor better than a binary decision all at once just to invest. We can't predict our performance or we do it, as Steve says, but I just know from experience that is not a bad strategy for people to use. And I also would comment that investors should not participate in this style if they don't have a long-term perspective, because it is one of those styles of hedge fund investing where it can do nothing for a year, it can lose 6 or 7% for a while, and then all of a sudden, when there's some big shocks in the world, it has right tail properties, it tends to be long volatility, it tends to perform the best. So I always advise investors, it's going to be a little lumpier in terms of its performance profile than some other styles of hedge fund investing. You should probably think of this as a 2.5 or 3 year investment. You should probably not put it all to work on one day. And you should probably not try and time when you're going to increase or decrease that as a percentage of your hedge fund portfolio. Pick a number and then just stay with it.
Yeah, I think that's good advice, Ken. One thing I want to do, another myth or so-called myth I like to debunk is another question we get along the same lines is this a long volatility trade? Does it do better in high vol markets? And again, being a scientist, the first thing we're going to do is empirically test that. And it's long volatility in the sense you let your profits run, but let's talk about the volatility of the marketplace. We decided to do a test. We went back through our systems and divided their profits into periods when the VIX is above X, the VIX is below Y, and try to do it where it's time even. And the answer, interestingly enough, it wasn't a surprise to us, but was a surprise to many people asked us this question, is that it does equally well in low vol regimes than it does in high vol regimes. For our stuff, the middle of the range actually didn't perform as well as the other two. It was still positive. So hopefully that's also helpful. This isn't just an investment that works in high volatility markets. It's all about discerning movement above noise in the market. And if volatility is low, you have larger positions, but you still can make the same amount of money.
I'd like to follow up on that and say what we're really doing, in the systematic world at least, is we're constantly buying puts and calls effectively. Every time we take a trade, we have a stop loss. That's our premium. We lose, we lose. We have the open-ended exposure to these shocks and these surprises and these multi-standard deviation moves. So if you look at the profile of a systematic trend-following kind of trader, or a risk manager, as I like to call myself, it's the profile of a buyer of puts and calls. And sometimes those puts are cheap, which is when volatility is low. And the calls are cheap when volatility is low, so we can get more of them. So that's why we're actually not really doing better when volatility is high. We do better when volatility goes from low to high. So and that's why it works in this complex adaptive systems world. If you think about it, if we don't know the future, if it's totally unpredictable, if these paths of the investment world can do literally anything, doesn't it make sense to buy puts and calls? Control your outcomes, keep them limited, have the open exposure to these surprises, these things that we don't know what's going to happen next year and the year after that. That's what we do. ultimately, and the academics have backed this up, ultimately we are the buyers of puts and calls.
Just, sorry, we're going to have to wrap up now. But just on the concept of timing your investing as a fund-to-funds investor, having done this for a long time, we've spent a lot of time, a lot of money on building systems trying to answer this question over a long period of time, and I can tell you we've stopped. There is nothing out there that we can find.
We're unanimous.
Yeah, it is. I do agree with the approach of coming into the market in stages as opposed to just putting it all to work at one point in time. But depending upon how you come in, you may end up not making as much money or feeling as if you made a mistake. There is no right answer to this, and we spend an awful lot of time thinking about it and talking about it. I'm going to have to turn it back over to Steve, and thank you all very much for coming. Thanks, guys. I think you did a great job.
Thanks, Ken. I'll make this brief. I've got three things really to say. The first is best practices has just come out. This is our finest work. This is best practices in alternative investing, portfolio construction. It's outstanding. But when you get this is the first copy that came off the printing press. Go to the inside cover. Look on the inside cover to the left part of the Research Council. I want to honor two people in the room here. Jeff Silverman is anonymous, and sorry, Jeff, I had to out you there.
I didn't even see him here.
And Ken Tropin from PJM Capital. We lost half of our underwriters on the Research Council last year, and this thing took us 2 years to write. Cost money. Everyone's a volunteer who is writing it. It's just outstanding, and I want to honor these people. Ken is also a force in nature at the Shelter for the Homeless. This is a place where society has thrown away these men, and Ken has transformed that. No one knows this. I'm outing Ken on this too, and I want to honor these people. But secondly, most importantly, I'm thrilled today. Not that we're just releasing best practices, but Bob Aaron's back. Bob Aaron was our original underwriter on the Founders Council. He is back. He's with HedgeServe. They're starting up a new company. And Bob, let's break all the rules. Tell us what you're doing. Tell us what HedgeServe is.
HedgeServe is a sort of a new type of hedge fund administrator. And I'd like to date myself with the rest of the group. About 30 years ago, I joined a firm called Commodities Corp, and I built back office and risk control systems for a couple of up-and-coming CTAs, guys like Bruce Kovner, Mike Marcus. I think we had a $200,000 managed account with Paul at the time. And we took that data, and it was a daily accountability. It was a daily NAV. 15 years ago, formed a company, DPM. We spun out of a trading organization, and we continued the process of a daily NAV, along with another group with a couple of guys by the name of Jim Kelly and Gene Manello. And we took daily net asset value and really turned it into, I think, the standard for the industry through to today. A lot of people were doing monthly, weekly reviews, but daily is the only way you can really look at it. We've now launched HedgeServe with a new platform where we've gone away from taking the data away from the trader and running down the street and processing it. Where we actually work, we take our database, put it in the trader's office, let them have it, let them see it, let them drive their own systems and create their own reports. They have all their proprietary information. They don't have to use our reports. But then we take the data out of that, and we still do the independent verification, valuation, independent reporting to the shareholders. I think with the new regulations that we're going to have, the new response for information that traders are going to have to make, I think that's really going to be the future going forward, where the traders and the administrators don't duplicate efforts and sadly sometimes come up with different answers that take lots of time to reconcile. So with Jim Kelly and Gene Manella, we started the new operation. We launched with about $10 billion in funds this month. We have about $50 billion due to come onto the platform by the end of the year, and then we'll take it from there. I'm happy to be back.
Yeah, we're glad to have you back. One thing about HedgeServe, and I will say this for them, I thought, this is another hedge fund administrator coming online, but once I went to New York, visited with them. There's this thing in the industry that hedge funds self-administer, and you say, gosh, why are they self-administering? You need like an independent verification party. Well, hedge funds self-administer because the quality of administration is just not up to their level of reporting. In other words, they're dealing in instruments that are exotic and difficult. HedgeServe does that. It goes up to that level of detail and information. So keep your eye on this space, but most importantly, pat him on the back when you see him. He's done a great job. He's written a check for us, and that's really important. Thank you, Bob. And thank you, Ken. Another good one. And Peter, Ken, Steve, good job. Thanks very much.